Bloomberg Audio Studios. Podcasts, radio, news.
CEO Brian Moynihan is holding an investor day this week. It's first in almost 15 years. Moynihan describes the firm's strategy as, quote, responsible growth. And now some analysts are wondering if that mantra will be enough to satisfy investors. One of those analysts, Mike Mayo. He is head of U.S. large cap bank research at Wells Fargo Securities. And last week, he was named #1 large bank all-star analyst for a 6th straight year by the Extel poll. And Mike joins us now. Mike, great to see you.
Thanks for having me.
So responsible growth, that's the stated strategy. Has it just run its natural course and he's extracted all he can from that idea?
Well, you have to understand, CEO Brian Moynihan of Bank of America took over after the global financial crisis, and his main job was to steady the ship. I think Bank of America under Brian Moynihan have been great risk managers, but this decade they've not been great risk takers. So I expect them to lean in more to the growth part of their responsible growth theme.
Got it. Okay, so Bank of America's argument is that it's working on it, it's catching up right now. It's already made clear that net interest income will be up 6 to 7% at the end of 2025. What do you hope to hear from BofA's management when they discuss all these targets on Wednesday?
Well, I think the most important target is what do you expect to have for returns? Bank of America has a premium franchise. They're #2 in U.S. retail, #2 in wealth management, top 5 global investment bank. That's really good stuff. So why have their returns only been 14% this decade? So I'm looking for a new return target of about 16 to 18%. So how they get there and how they put some meat on the bones for those growth strategies will be very important this Wednesday.
Okay, that makes sense. And you're referring to the return on tangible common equity. And right now, they've set a target, I guess, of the high teens. It's currently at around 5%?
No, they currently, Bank of America, I don't know of them to have any target. So first of all, let's hear a target.
Oh, excuse me. Analysts are expecting something in the high teens.
Okay, so I think 16 to 18% seems reasonable, but it's really how are they going to get there is what's going to be important. And I think when it comes to traditional banking deposit taking, Bank of America has excelled. But for being such a strong bank, they've underperformed in terms of growth of the less traditional activities, wealth management, credit cards, banking, trading, even total loan growth for the last 15 years has lagged at Bank of America. So there's no skill in never taking risk. You don't want them going back to 2007 when they took too much risk. So this has been a risk-off company in a risk-on year to explain the stock price. So I expect them to have more of an opportunistic risk mindset going forward.
You've mentioned the areas where they have room to grow. Where is it already strong? Where is it, kind of delivering already to the way that it can, the maximum that it can?
Well, wow. I mean, Bank of America's $1 trillion of retail deposits. I mean, those customers really love the service, and they have connections with, automatic bill pay and, all sorts of interactions. They've had 3 billion interactions with their Erica chatbot for the past decade. Talk about AI. So that's really working. The bread and butter, the raw materials of a bank are deposits. That's worked really well. The challenge and opportunity is to leverage those relationships to do more.
Okay. Are we going to get any kind of insight into succession planning at Bank of America? They're going to showcase some senior executives below the CEO tier, according to our reporting.
Well, to up the drama, and the bar is low for bank analysts, okay? It doesn't take much to have some drama, but they recently named 2 co-presidents, Dean and Jimmy, as we know them colloquially. It'll be the first time we get to see those 2 individuals in their new roles, and they're overseeing jointly Bank of America's 8 lines of business. So the question is, how are they going to instill extra intensity, growth, and accountability to those 8 lines of business? And so it could be one of those 2. Alistair, the CFO, is very capable CFO. So I'd say it's a 3-person horse race to become the next CEO, and this will be a chance to the investment world to analyze them.
So is it overstating things to say that this investor day is crucial to BofA's future?
I think this is the right time for Bank of America's Investor Day. It's the first one in 15 years. So what is Bank of America's plan from now until the end of the decade? How are they going to improve their growth? How are they opportunistically going to take risk? How are they going to improve their returns? And lastly, with this world and their experience with AI and technology, how are they going to improve their efficiency? This should be one of the most efficient banks on the planet with all the tech and AI that they've done. So that'll be really interesting to hear.
All right. I also want to get your take on Citigroup, because you have recently objected to the CEO and now Chairman Jane Fraser's her retention bonus. You call it the latest example of the firm paying in excess. So this is a company problem or a culture problem at Citigroup?
This is a 25-year-old problem at Citigroup. Citigroup's CEOs have made I think over $400 million in the last 25 years when the stock price has gone down 3/4 and the stock market's gone up 3x. So I've written about that. I wrote that in my book, Exile on Wall Street. I talked about it when I testified to the inquiry commissions related to the financial crisis. And I'd say in the case of Jane Fraser at Citigroup is my first, second, and third top picks. So I love Citi stock.
And you love what they've been doing.
And I love what Jane Fraser's been doing, and I think they're going to succeed, but I might be wrong. And if I'm wrong, guess what? I'm probably going to make a lot less, and I think Jane Fraser should make less too. She shouldn't get a retention bonus now, at least until they get double-digit returns, at least until the regulatory consent order is lifted, or at least let the year end. So I just thought that was, at best, premature to give her a retention bonus at this time, even while I think this is a generational change in how Citi conducts business.
Okay, so you don't object to her ascension to chair of Citigroup or anything like that. It's just kind of the prepayment of everything first.
Absolutely, and this Citi has a long history. They implicitly failed 5 times the last century. Again, I write about this in my book. I write in my book about their poor, pay for performance practices. So I literally, when I put out a note about Jane Fraser, the recent retention bonus, I literally quoted my book. And here we are 15 years later with some of these same bad practices. Now, I understand it because she's probably the best CEO they've had, since the merger in 1998, but she's still has to deliver. It's kind of like you see someone in the gym and they're training really well and they're doing push-ups and sit-ups, but when it comes to game time, do they actually deliver? Next year is when they have to deliver.
Going back, you look at Jane Fraser, her background is as a management consultant at McKinsey, and James Gorman was also a management consultant, and he basically turned around Morgan Stanley. Are management consultants maybe better at running these big banks than most bankers?
Stop. No, it's not one size fits all. As for those who remember, I said the same thing about Morgan Stanley early last decade. They were my 3 top picks: Morgan Stanley, Morgan Stanley, Morgan Stanley. You have the clips on Bloomberg. You look it up, and everyone said James Gorman wasn't a banker, wasn't a trader. He's a consultant. Forget about him. And then all of a sudden, he walked on water by the time he left. And you've had some bad consultants who became CEOs too. But I think Jane Fraser, she has a great blueprint, architectural blueprint for how to run Citi for the next 25 years with the 5 lines of business and holding the 5 CEOs of those line of business accountable. So it's a simple but powerful move that people underappreciate. So I think that's a game changer for how Citi's going to perform and execute the next few years.